So, 1981 just finished, and let's have a look at how Berkshire is doing. In the past 17 years that Buffett has owned Berkshire, its book value per share, like a rough measure of the company's value per share, has increased from $19.46 to $526.02. That's 21.1% compounded annually. Return on equity capital fell from 17.8% last year to 15.2%. So, over the past few years, letters to Berkshire shareholders have focused on inflation. Now, usually interest rates are raised to deal with inflation, and that's what's been happening in the early 1980s. Now, what effect do higher interest rates have on business values? Well, as interest rates on government bonds rise, the value of businesses, and thus stocks, fall. Government bonds can be seen as passive investments. With a business, you must analyze and you have to run it as well, perhaps, and that takes a lot of work. But a government bond doesn't need you to do anything. It's risk-free. It just pays you interest every year. And today, in 1981, tax-free bonds are paying 14% a year in interest. So if a business earns a 14% return on equity, that business is not worth 100 cents on the dollar. That 14% return on equity is before tax. You still have to pay tax on dividends and capital gains. So if you're in the 50% tax bracket, for example, that 14% return on equity is actually 7% after tax. Now, would you rather spend hours analyzing a stock that gives you 7% or buy a government bond and earn 14% passively? Obviously, the 14% is better. So, if stocks are giving you 7% after tax and government bonds are giving you 14%, you'll pay half as much for stocks as you will for government bonds because government bonds are paying you twice as much. And that's the situation we currently face in 1981. This is why it's dangerous to just use historic PE ratios without considering things such as inflation, interest rates, etc. Interest rates on government bonds are very high, making the earnings that stocks generate not as valuable as they used to be. Now, the relationship between this business value, what the business is worth, and market value, that is what it is selling for, it's not perfect. Over long periods of time, the relationship is quite close. But in any given year, there are often big gyrations. Those gyrations are what create opportunity in stock markets. Now, that opportunity isn't just for individual investors like you and me. It's also there for corporations who can acquire other corporations in the stock market. Let's look at acquisitions from two simple views, just the bad and the good. So, for the bad acquisitions tend to happen because of three reasons. One, they're exciting for management. Come on, making deals is fun, even if it's not always profitable. Two, size matters. Well, at least in the minds of many CEOs. Managing a bigger company often comes with bigger compensation, bigger prestige, etc. And three, many CEOs believe their managerial kiss can turn the business toads that they acquire into profitable princes. So acquisitions often don't make sense for shareholders. Their managements might say, okay, we'll pay 2x the current share price. But if shareholders can buy shares at X, then shareholders are obviously coming out poorer as a result. Well, at least that's the case for bad acquisitions. Good acquisitions tend to come in two forms. Either a great business is bought, or a great management team recognizes an underperforming business. It's usually a business that it can really turn into a profitable prince through its managerial kiss. So what's this great business? What does that look like? Well, it's one that has pricing power and very low capital needs. That combination allows a company to deal well with inflation. as prices in the economy increase, the business can raise its own prices. The business also doesn't need a lot of capital to run, so it doesn't have to keep buying more and more expensive inventory or equipment or, invest in more expensive factories as inflation keeps raising prices. Finally, to cap things off, in last year's letter, we talked about how Berkshire Hathaway's earnings is like an iceberg. A lot of it doesn't show up in its income statement. It can't be seen, but it is there. Well, this has now increased to the point that the earnings that don't show up on Berkshire's income statement are greater than all of the earnings that do. This is a situation set to happen again in 1982.